Hello friends. In today's video, we are going to discuss about a widely used metric for picking stocks, PE ratio. Welcome to Aarti's Tax Info. So what is PE ratio? The current market price of a share divided by earnings per share. That will give you PE ratio. So this is a metric used to understand if a stock is expensive or cheap. If the earnings are expected to increase in future, the share prices will naturally go up and vice versa. So if the share price grows much faster than the earnings, the PE ratio will be high, and if the share price falls much faster than the earnings, the PE ratio will become low. So in a sense, if a high PE ratio, if the stock is having high PE ratio, it means that the stock is expensive or overvalued, and there is a possibility of fall in share prices in future. So if the PE ratio is low, it means that the stock is undervalued or cheap, and there is a chance for the share price to go up in future. The main two types of PE ratios are TTM PE ratio and forward PE ratio. TTM stands for trailing 12 months. It is obtained by dividing the current share price by the EPS of the last 4 quarters. Forward PE ratio is calculated by dividing the current share price by the projected EPS of the next 4 quarters. So generally, forward PE ratio is considered better than the TTM PE ratio. The main reason is that TTM PE ratio is based on the past performance, and your past performance does not guarantee future earnings. Also, the TTM PE ratio is based on the earnings released every quarter, but the stock prices move on a daily basis. So because of this reason, generally the investors tend to look for forward PE ratio. So if the forward PE ratio is less than the TTM PE ratio, generally the analysts expect the earnings to increase in future. And if the forward PE ratio is higher than the TTM PE ratio, the earnings are expected to decrease in future. So the only challenge when it comes to forward PE ratio is that it is based on the projected EPS, and this projected earnings or projected EPS is given by the company. So there's a chance that the company figures might be manipulated, or it might either be deflated or inflated due to several reasons which only the management knows. Also, the stock market analysts might give you different estimates of different companies, which might be very different from the estimates that the company has given. So this creates further confusion. So this is the limitation when it comes to forward PE, absolute PE ratio and relative PE ratio. Your TTM PE ratio or forward PE ratio, that is what we call the absolute PE ratio. This is the most widely used PE ratio, but the major limitation with this PE ratio is that different industries trade in different valuation ranges. That is, the PE ratios of metal stocks are generally much lower than that of the PE ratios of FMCG stocks. But this does not mean that metal stocks are cheaper than FMCG stocks and hence more attractive. This limitation is overcome by relative PE ratio. Relative PE ratio compares the absolute PE ratio over the last several years. That is, it compares the current absolute PE ratio over a range, say 10 years. So suppose if the current absolute PE ratio of a stock is 27, and in the past 10 years the highest PE ratio of the stock was 30. So the relative PE ratio would be 27 divided by 30, that is 0.9. So how to read this? If the relative PE ratio is less than 1, it means that the absolute PE ratio at present has not surpassed the best PE ratio it has given in the past. And if it's more than 1, it means that it has surpassed the best PE ratio given by it in the last 10 years. So what are the limitations of using PE ratios? The first limitation is the one I've already mentioned in the video. That is, if you are comparing a PE ratio of a metal stock with that of an FMCG stock, it will not give you any meaningful information. So if you are a newbie to the stock market and base your decision on a comparison like this, the stock that you pick might be wrong. The second is the presence of debt. Debt can affect both share price and earnings. So if you have two companies with with the same parameters on all fronts except for debt, one has debt and the other one doesn't. But this doesn't mean that the company with debt is a bad one. If the business of that company is a solid business, it may outperform the one with no debt. So if you only look at PE ratio and not other factors, in this instance debt, the decision that you make might be a wrong decision. And the final one is that the PE ratio is calculated ultimately based on the estimates given by the company, and this is prone to manipulation. So if the figures given by the company is wrong, then the decision that you make based on PE ratio will also be wrong. So what is a good PE ratio? This entirely depends on the industry that you're picking. Some industries have higher PE ratios and some have lower PE ratios. So how do you understand if the PE ratio of the company that you have picked is high or low? First, compare it with other companies in its own sector and then compare it with companies that are from a different sector, and finally compare this with the PE ratios of the market, that is Nifty or Sensex, whatever it is. This will give you a fair understanding of whether the PE ratio of that particular stock is high or low. If you look at Nifty, the average PE ratio of Nifty is somewhere between 20 and 25. So the shares having PE ratio more than this may be considered negative, and the shares having PE ratio less than this may be considered better if you're going to pick a stock based on this. So what is the takeaway from this video? The thing is that no single ratio can tell you everything about a stock or a company. So before picking a stock, do not go just by PE ratio. Have a set of financial tools that can be used to analyze whether a company is worth investing or not. If you don't have this capability of analysis, you can go to an analyst who can read balance sheets and give you an informed decision whether a company is doing good or not. I hope this video was of some use to you guys to understand better about PE ratio. I'll see you in the next video. Thank you.